What is up, and welcome back to the CFN podcast. Today we're going to be speaking about life insurance and some of the most common questions and misconceptions that we hear.
Why do most people view life insurance as an expense instead of a strategy?
So a lot of people view life insurance, which they would consider as, I would say, death insurance, as an expense because the only individual that receives proceeds is upon them actually passing away. But really, life insurance that is a permanent policy, figure a index universal life or a whole life policy, is actually what we would call a life insurance policy where, yes, there's a death benefit, but it actually accumulates cash on a tax-free basis that they can use while they're alive.
At a high level, what's the difference between term and permanent insurance?
So term insurance is like renting a home. When you rent a house, you sign a lease, you have the house to live in for a year or so. And when you want to leave, right, you take your bags, you take the kids, and you go to another place. When you own a house, which is permanent insurance, you actually have a mortgage typically, and every month you make a mortgage payment, you actually are accumulating equity in the policy called cash value. The policy actually lasts forever, just like when you buy a house, right? The house is yours forever, you pay the mortgage, equity accumulates, and if and when you want to sell the place, typically you're going to sell it at a higher rate than you bought it. So again, term is like renting a house, permanent is like owning a house.
When is term absolutely the right choice?
Term insurance is most commonly used when people typically need the highest amount of insurance for the cheapest cost possible.
When does permanent insurance make more sense?
Permanent insurance is typically used in a couple of different areas. When somebody says, I want insurance, I want a death benefit amount that is going to last until the day that I die, and obviously we don't know when that date is, but a lot of people are starting to use life insurance or permanent insurance as an asset class, where they're actually putting money in every single month. And when they're doing that, it's actually funded with after-tax dollars. The money is actually growing on a tax-free basis. They can access the money before 59 and a half. There's no 73 RMD rule. So if they're looking for more of a conservative way, again, as an asset class, almost like a bond-like return, a lot of people today are pumping money into permanent plans as well.
Is it ever an either or decision, or are there circumstances where it can be both?
So a lot of people will sometimes say, do I own or should I purchase a term policy? Should I purchase a permanent policy? Or should I get a blend? I call it a vanilla chocolate swirl ice cream cone with both, right? So in my world, personally, I actually have three types of plans. I personally have a term, which basically gives my wife and kids a large amount of coverage while my kids are young and still on the payroll. But I also have two different permanent plans where it's index universal life as well as whole life, where again, we pump money into it every single month and every single year. And we use it, one, for permanent tax-free death benefit proceeds whenever it is that I or we pass away. And separate from that is that we're using that as an asset class to accumulate cash where we could take out money from it today. And when we go to do that, we don't have to ask anybody's permission. I go to do it and I'm not paying tax on that. So a lot of people will use this as a way to fund real estate projects or, buy a car instead of going to get a loan from a bank. They're getting the money from their plan. And the coolest thing about that is that, let's say you have $500,000 of cash in the plan. You go to pull $100,000 out of that plan, you have a $400,000 cash value balance. But interest and or dividends are accumulating on the full $500,000 as if you didn't take money out. Not all carriers work that way, but the ones, for instance, that I personally have actually do. So again, personally, I have all three types, but it really depends on the person's situation where they're going to use which one and why.
What are living benefits and how do they work in real life?
So a lot of life insurance policies today have living benefits that are actually attached to them. That if, God forbid, the client has a terminal illness and they need to get, let's say, some sort of medical treatment, they can actually access part of that death benefit while they're alive to get medical help. And even if it's not medical help, they just want to enjoy an unbelievable, vacation with the family before they pass away, unfortunately, prematurely, they've got the ability to do it. There's other living benefit riders on policies that allow it to, if somebody becomes disabled, they can actually trigger the death benefit early on. And if there's a long-term care event, meaning they can't do 2 out of the 6 acts of daily living, they can't wash themselves, they can't feed themselves, they can't move from place to place, and they need either a home health aide in their house or they need to go to a facility, they can use part of that death benefit before they die, again, to pay for the cost of, again, a home health aide or an actual facility. So a lot of these policies today have these attached to them.
How do high income or business owner clients use life insurance differently?
High income earner or business owners use life insurance in a few different ways. Number one is they're using it as a tax-free proceeds or death benefit proceeds that when they pass away, typically within a 2-week period, their business partner or spouse, depending on the use of the plan, is getting a tax-free injection of capital, again, into their personal life or their professional life. A business owner that has a business where they've got, money tied up in inventory, or somebody that invests heavily in real estate or commercial real estate, or in, let's say, diamonds or jewelry, they might have a lot of assets or net worth, but it's not liquid. So a lot of business owners will use this as an immediate, again, injection of capital, where they don't have to sell off inventory, or they don't have to go on a fire sale to sell a property, and they're able to live their life or continue the business that way. Separately, when people are higher net worth, a lot of times they're going to hit an estate tax issue. Now, an estate tax issue is an ever-changing number every single year, and no one knows, A, when they're going to die, and no one knows what is the value going to be of their net worth. They can project it, but they don't really necessarily know. And the biggest thing that they don't know is that what is the estate tax number or the exclusion number. So a lot of people are looking at ways to offset, again, the estate tax that they'll incur upon a passing. And a lot of people that are what I would consider that are mini millionaires, they're retirees, that they're, they're just retired 65, 70, 80, what have you, and they have $1 to $5 million of assets, if you will, in a qualified retirement plan. So that is a 401k, IRA, SEP, or simple. A lot of these individuals don't realize that upon them dying and their children or a non-spouse party inheriting that money, that beneficiary has to pay Uncle Sam all of the taxes owed within a period of 10 years. So more than ever today, people have so much money built up in pre-tax accounts that their beneficiaries, kids or grandkids or nieces or nephews, are going to have or pay a major tax liability, and people are using life insurance as ways to, again, mitigate or offset that tax that they will incur.
What role can it play in creating predictable or protected income?
So life insurance will play a role in predictable income or a return, in that life insurance, the cash accumulation on there, again, it can be used as an asset class and used while you're alive. You're funding it with after-tax dollars. The money is essentially growing tax-free as long as you have $1 of insurance in force. As I mentioned earlier, you can access the cash at any age as long as there is value, and then upon passing, there is no taxation on the money. An individual that has a life insurance policy in place, or first of all, doesn't have a life insurance policy in place, that individual dies, that surviving spouse or children has to either liquidate, meaning sell a home, sell investment properties. If they own a business, is fire sale the business, and use whatever cash is readily accessible. So we don't know how much that money is, or we don't know whatever that value is. For every $1 million that somebody has in death benefit, when they die, that's tax free. So let's say the person dies today with $1 million. If they're getting 6% on that $1 million, that's going to generate a $60,000 a year, interest on that account. So if they never want to touch the principal $1 million, and let's say they have a $5 million death benefit, that individual surviving spouse will be able to have $300,000 a year of income that $5 million will throw off without touching the principal balance.
Who is life insurance most critical for?
So who is life insurance most critical for is going to be anybody that has dependents. That could be, spousal dependents, a business partner, or even a key person that is part of your business. It's super, super important that it's there. As I said, it's a tax-free, immediate injection of capital upon somebody's sudden death. And then the other part is somebody that has max funded their 401k where they've already gotten the match on that money. And that individual is looking at alternative ways that they're able to save money on a tax-free or a tax-efficient basis. And they are looking at ways that they have readily available cash that they can touch and use at any point in time. And they don't have to wait for the 59.5 qualified retirement plan rule.
Do single individuals or younger people need life insurance?
So if somebody is single or they are younger, right, they have no dependents, I would start with if somebody has no dependents, there's no real need, I would say, to have a term policy. Maybe if they're looking to get, married or have kids, or they have dependents in the very near future and they want to lock in insurability, it would make sense. But certainly somebody that is younger, that has liquidity, and they're looking at putting money into something that's going to allow it to grow, in that sense, I would, advise them to get or look into getting a permanent plan.
What about people who feel like they already have enough assets?
So a lot of people will say, I'm all set. I have everything taken care of. I've got money in real estate. I've got money in my business. I've got money in my retirement plan, etc. What I would say is when I sit down with somebody or look at myself and that, God forbid, day comes, most of the time it's never enough, right? And it really depends upon, what side of the fence the individual, sits on. Some people are okay with their family members struggling upon their death. I mean, it is sometimes that's how they think. But I would tell you that take a long, hard look at, if you were to pass away today, what does the household or the business need every single year in income in order to live their lives, right? So somebody that, let's say, needs $300,000 a year of income coming in, they need a $5 million death benefit, assuming a 6% return and a 3% growth rate as far as inflation is concerned. If they die with $5 million, they have a 6% growth rate, and again a 3% inflation rate. That surviving spouse will have $300,000 a year to live off of for about 22 years. So if 22 years is enough for somebody to be okay, then that would be the number.
How does age and health impact urgency?
So no one is, now I would say is the best time for anybody to look into getting, life insurance or any type of insurance product possible, because you're never as young and as healthy as you are today. But all life insurance plans are based on either gender, whether somebody smokes or not, their overall health, and other medical issues that arise. So just because somebody says, hey, I want a life insurance policy, doesn't mean that they're actually insurable. And a lot of times we've seen where people wait too long, become uninsurable, and they're not actually able to get a plan that they would have wished they've gotten years ago.
When does someone not need life insurance?
Somebody doesn't need life insurance where if they have dependents and they don't care, where I've heard a lot of people say, well, I don't want to, if I die, I don't want my wife dancing on my grave, and they say these dumb things. So in my mind, that's, not caring. But joking aside, An individual doesn't really need life insurance if they don't have dependents and it's really them that they're concentrating on. But as I said earlier, they don't need death insurance at that point, but they might want to expose and look at, the life insurance plan that is again used as an asset class to accumulate cash on a tax favorable basis. Those would be the scenarios I would say somebody doesn't need or as a policy.
What should people who own life insurance review in their current policies?
So when people buy an insurance policy or an account, right, they typically get it, they get the policy plan itself, throw it in the cupboard, and really never look at it again. And what I would advise people to do, not only in life insurance, but all of their finances, whether that be life insurance, disability coverage, long-term care, their property insurance, their kids' college plan, their retirement plan, is at minimum once a year, do an overview, meaning a financial checkup. Just like you go to a doctor and you do an annual physical exam, which I'm not really the best at, but joking aside, you do a physical checkup, you get your height, you get your weight, you get your blood work, everything looks good, great, see you in a year. Do a financial checkup every single year, because the only thing that's constant in life is change. And as somebody goes through life and there's personal changes and professional changes, good and bad all around, it is important to review those as it relates to life insurance, because if they don't have a need for it anymore, they need to get rid of it. If they have had, children, right? They've had multiple kids that have been added to the family, which is a blessing. They have a higher need for income coming to the house. If there was a divorce, if somebody became a widower, this sort of thing, things change. And again, you've got to keep up with those changes.
Is focusing only on price a problem?
So focusing on price is not a problem. If somebody says, I want the cheapest policy possible with the most amount of coverage from the best company, you can find it out there. So focusing on price is not a problem, but I think what a person needs to do is start with, what is the purpose of insurance? Is it needed in a personal setting or in a business setting? And if it's needed in a personal setting, as I said a minute ago, where that individual has a spouse and has kids and has dependents, it's really based on what does the household need and require as far as income in the event that that person wasn't there. And then we back into that number, as I said a minute ago. So if somebody's house needs $300,000 a year of income, and they need it, again, they need $300,000 a year coming in, they need a $5 million policy for that $300,000 to last 22 years. So the best way to do it is to, what does the household need? And for how long? And then back into the total number that's needed. But again, if somebody says, I just want the cheapest plan for the best company, that can be done.
How many do you have left?
3. Good or no?
Yeah. Can you share an example where life insurance made a major impact for one of your clients or family members?
So we've had, multiple situations. I'll give you 2. We've got a client that actually was one of these clients that said, I want the cheapest plan possible. I really don't want my spouse to dance on my grave and be happy if and when I die. But this individual took out a plan about 9-10 years ago. It was $1 million of coverage, and unfortunately got diagnosed with a terminal illness. And he was actually able to accelerate, meaning use part of that policy while he was alive to get medical treatment outside of the country, which he actually did do. Number 2 is we've had, many instances where people have, passed away. One of our advisors, unfortunately passed away. And when his fiance called me and said, Dustin, what does so-and-so have in place? Does he have anything in place? I said, yes, he actually does. And I shared with her what he had. And the voice on the other end of that phone was that she was just, she was so grateful for what her husband had gave her and the life that he had gave her while he was alive. But the fact that he had planned accordingly when, and God forbid that occurred, he passed away, that she didn't have to sell the house. She didn't have to sell the car. She didn't have to, uproot her life, and she was able to maintain the life that she had when he was working. Just hearing her on the other end of the line was something that will never leave my head.
Can you share a situation where someone didn't have the coverage they needed and what problems came from that?
So we've had situations as well where people don't have that in place for one reason or another. I have somebody that I know in this industry that was, about, call it pre-retirement age, and passed away suddenly from a heart attack. And again, another individual in this industry that unfortunately didn't have the proper things in place. And unfortunately, it impacted the family in a personal sense in a really negative way. And again, to see that and how that impacted the family in a negative way was, I said a minute ago, on how it was a positive. Not the instance was a positive, but by somebody having it in place was a positive. What that did was again, that also would never leave my head as well.
And lastly, what is one simple step that people listening can take today to help get clarity on whether or not they need life insurance?
I think to gain clarity of whether somebody needs life insurance or not is, number one, is, do you have anybody that depends upon you financially? Whether that be a spouse, whether that be kids, grandkids, nieces, nephews that individual's raising, or even a business or a business partner that depends on you. And if the answer to those questions are yes, it's my opinion, it's not a matter of do you need it. The answer is yes, 100% you do. And then the question is well, what plan do I need, and what amount of coverage do I need, and then which plan is right for me?
I would just say, like how you said before, it doesn't have to be us or anyone, just make sure you reach out to someone.
It doesn't have to be us. I would just advise you reach out to somebody to get that taken care of ASAP.
That's it for the client side. There's some recruiting. We could shift this into recruiting. No,
Not right now.
Okay.
I think that's.
Well, how do we want to close
We
it?
done?
Oh, yeah. I like that. Yes. Just say again, thank you for listening, and then
I hope this helped bring clarity some
I
of
was
your
gonna
life
s-
insurance questions.
Yeah, or that I was gonna say, if any of this hit home, feel free to reach out to us. You know how we always end it with, just reach out to us, please.
But I would start by saying I hope that you found
Yeah.
this valuable information.
Hope you guys found this information valuable. If anything hits home or you want to learn more, reach out to us today.